Buying a home is a big decision. It's exciting and maybe a little scary. You want to make the smartest choice for your future. One of the first decisions you'll face is how to finance your purchase. Do you try to take over the seller's existing mortgage, or do you get your own loan? This essay will guide you through both options: assumable mortgages and buying with your own financing. We'll break down the pros and cons of each so you can confidently decide what's best for you. Let's get started. An assumable mortgage is exactly what it sounds like. It means you take over the seller's existing mortgage. You step into their shoes and make the remaining payments. This can be appealing, especially if interest rates were lower when the seller got their loan. Not all mortgages are assumable, though. Typically, only certain government-backed loans like FHA loans and VA loans are assumable. Assumable mortgages can offer some attractive advantages. First, you might snag a lower interest rate than what's currently available. This could save you thousands of dollars over the life of your loan. Second, closing costs. Those fees associated with finalizing a mortgage are often lower with assumable mortgages. This means more money in your pocket at closing. Third, the closing process itself might be faster since you're not starting from scratch with a new loan application. These benefits can make assumable mortgages a tempting option. However, it's crucial to consider the potential downsides too. Section 4. Drawbacks of assumable mortgages. Potential pitfalls to consider. While assumable mortgages offer potential savings, they also come with some potential drawbacks. It's crucial to be aware of these before making any decisions. Understanding the full picture can help you make a more informed choice. One important factor is the equity gap. This gap can significantly impact your financial planning. The equity gap refers to the difference between the current mortgage balance and the home's market value. If the seller hasn't built up much equity in the home, you might need to make a substantial down payment to cover the difference between the mortgage balance and the purchase price. This can be a significant financial burden, especially for first-time homebuyers. Another issue is limited availability. Assumable mortgages are not as prevalent as traditional mortgages, which means your options might be limited. This scarcity can make it challenging to find a suitable property that offers an assumable mortgage. Assumable mortgages are less common than traditional mortgages. This rarity can sometimes lead to a longer search process, requiring more patience and persistence on your part. You might not find a seller offering this option. Even if you do, the terms might not be as favorable as you hoped. It's essential to keep this in mind and be prepared for a potentially longer and more challenging search. Finally, even though you're taking over an existing loan, you'll still need to go through an approval process with the lender. This process can be just as rigorous as applying for a new mortgage. They want to ensure you can handle the payments. Lenders will scrutinize your financial history, credit score, and current income to make sure you're a reliable borrower. Don't let the potential downsides scare you off completely. Assumable mortgages can still be a viable option for many buyers. It's all about weighing the pros and cons and seeing if it aligns with your financial goals and circumstances. They're just important factors to weigh as you make your decision. By understanding these potential pitfalls, you can better navigate the home buying process and make a choice that's right for you. all your needs and preferences. Section 6. Making the right choice, weighing your options. In this section, we will explore the critical factors you need to consider when making one of the most significant decisions of your life, choosing the right home. So, how do you decide which option is right for you? The process can seem overwhelming, but breaking it down into manageable steps can make it easier. It all comes down to your individual circumstances and goals. Start by having an open discussion with your family or partner about what you want in a home. Carefully consider your financial situation. Review your income, savings, and any existing debts. This will give you a clear picture of what you can afford. How much can you afford for a down payment? This is a crucial factor that will influence your mortgage options and monthly payments. What interest rate can you realistically qualify for? Interest rates can significantly affect the total cost of your mortgage over time. Think about your long-term plans. Are you planning to stay in this home for a few years, or is this your forever home? How long do you plan on staying in the home? The length of time you plan to stay can influence the type of mortgage you choose. Once you've considered these factors, it's time to seek professional advice. Professionals can provide insights that you might not have considered. Talk to a mortgage lender and a real estate agent. They can offer valuable guidance and help you navigate the complexities of buying a home. They can help you compare the costs and benefits of each option based on your specific situation. By weighing all these factors carefully, you can make an informed decision that aligns with your financial goals and personal aspirations. Section 7. Conclusion. Take the next step towards homeownership. Buying a home is a significant milestone, and choosing the right financing option is crucial. By understanding